Hello, everyone. Today is March 7th. It's Market Monday. We have a continuation of the Ukrainian conflict going on over the weekend. So it seems like just the same news over and over again. It's not getting any better yet. And this definitely impacted markets. I mentioned this on Friday. So tough week. We're down 1% on the S&P and Dow. NASDAQ down 3%. So European countries are down 10%. We had one of my favorite stocks, Mercedes-Benz, just, get hit hard last week. You got to think, is this an opportunity to come back in and buy it? And that is a lot of the conversation now. At what point does this become a buying opportunity now that prices are down? I'd say that not yet, but we're getting closer every day, it seems, doesn't it? The labor market was strong. No one seemed to care. European inflation wasn't as high as US, but that's going to change, we think, pretty quickly with energy prices going up to $125 a barrel. Look at February. It was a tough month, short month, but a tough month. March is probably going to look somewhat similar if we keep going on this particular trend. Oil has done well. So when you look at the stock market in general, you get this question, why are we still owning stocks? Because there are probably 40% of the stocks out there that are still in uptrends or at least sideways trends to stay in with them. And we're not trying to time the markets here, but if you see that there are places in the market that are doing okay in comparison to others, then that means that the market is still doing what it should do in terms of supply and demand. Money is still in the stock market. A lot of questions today about whether or not we should invest for inflation a certain way. The answer is yes. The short-term Treasury inflation protected securities called TIPS generally are the best way to protect against inflation. Short-term rates go up, inflation goes up. These assets are definitely tied to inflation. There are longer term tips too, which have a little more risk to them. We prefer short term right here. The other question I get is, why are we buying oil? The oil, gold, all these commodities. The answer is we are buying oil. We do have some in the portfolio. Energy as a sector moves pretty quickly to the upside and can move very quickly to the downside. So we got to be careful about, the volatility in these things. There is within the portfolio, within the indices, an allocation to energy and other commodity stocks. They are not a very large percentage. So when you say overweight to energy, you're going from maybe 3 or 4 to 5 or 6. So in the end of the day, it's not going to impact the entire portfolio all that much unless you make a big bet. Big bets in energy are often risky bets. So maybe we're not going to go ahead as far into that energy trade as you might want to think you should go. From an earnings perspective, which really drives the market when people settle down, markets settle down, companies are profitable. Average gain of 31% in terms of earnings. If you think about it, same quarter last year, we were kind of coming out of COVID. So things were actually, kind of gaining traction pretty quickly. So that's a pretty good growth rate to be a part of. So when you start thinking about other things going on, where do you go? You stick with the big companies, primarily US companies, the companies that have free cash flow, that have profits that are, consistent. I don't think you want to make big bets here in terms of, long duration trades. I've said this before, long duration trade is an asset which is going to, grow in the future, but it's going nowhere now. It's, kind of like the one guy was telling me a long time ago, when you plant the seed, you expect that thing to be corn tomorrow. It's just not going to happen. There's a lot of time, energy, and effort between that seed and when it actually produces. You have to wait. And we're in the period right now, I think it makes sense to wait and let these things kind of go through the cycle and produce. The economy still looks strong overall. We just have this, war wild card that we're dealing out here. Yes, it is serious. Yes, we are paying attention. But when you look at the stock market in generally you want to stay in it. 70% of the time it will go up. That means it will rebound at some point, and very difficult to time these things. So when you look at where the emphasis should be, and we have been putting it, it's in large cap, primarily US. We've had international in here as well. Again, large cap better than small. Look at this for a second. This is the fear and greed index. And actually, when it gets red like this, you should say, sell everything. No, that's not what you should do at all. You should actually think about buying. As I mentioned earlier, when you get these extreme flows of fear and greed, you have to really take a contrarian view. Now, timing, you're never going to get timing right anyway, But this is one of the reasons why we're not selling everything, because we think this is closer to what could be an extreme fear indicator. This thing doesn't break very often. It's like a rubber band. It just comes way down or way up and then comes back. It can move quickly. I think right now we're looking for buying opportunities within the market as much as we are looking at taking off risk in the marketplace. So it's a very mixed message, I know, but that's kind of where the markets are telling us. So any questions, please feel free to give me a call. We are here to help, and be sending out March reports in another several weeks. But if you want to talk sooner, please feel free to give me a call. Thanks.